Breaking news, we now have an official outline of President Trump's major tax cuts. And I gotta say, this could wind up saving many of you investors watching a lot of cash. Now, he just laid out 6 categories that could soon get a complete overhaul. And that's why it's crucial that we break down how these major tax cuts will impact real estate investors just like you, and how much money you can see back in your pockets in 2025 if you act now on the insights shared in this video. Now, let's be serious, guys. This could be the biggest tax cut that we've seen in the last 10 years. Now, really quick, guys, if you enjoy videos like this where I bring you the most up-to-date information, and guys, I spent 3 days filming this video so that you could make savvy investment decisions in 2025, then please take a quick moment, hit that like button, hit that subscribe button for me. It really does matter a lot to me. Let's get into the content. So when President Trump eliminated federal taxes on overtime pay, tips, and Social Security income, essentially he was increasing disposable income for workers and retirees. Now, increased disposable income in the hands of these 2 groups of people is going to lead to increased consumer spending. Increased consumer spending is going to fuel economic growth. This can raise demand for vacation rentals, luxury properties, and also senior assisted living facilities, which we're going to get into in just a minute. Now, your whole goal here, based on what he's doing, is to expand your luxury vacation rental properties and the commercial component of it, the senior assisted living facilities. These are the 2 areas that you want to target and go after, because there's going to be increased demand over the course of the next 4 years while he's in office. Now, you can invest in those high-end senior assisted living facilities in retiree hotspots. We're talking about Florida, South Carolina, Arizona, and also those vacation rental luxury properties. Those are great markets for strong vacation short-term rental demand. Now, be careful with Florida because they have seen some crazy insurance cost increases. And from what I understand, a lot of their condos are not profitable. In Myrtle Beach, South Carolina, we have very profitable condos, and our cost to entry barrier is a lot lower. In other words, you'll pay $300,000 for a condo here, but pay $400,000 or $450,000, maybe even $500,000 for the same condo in Florida. And they both make the same operating income. So why not choose a cheaper place to invest and make great returns on your investment? Now, retirees have accounted for as much as 40% of all Airbnb bookings per AirDNA. That is 40% Airbnb bookings. Guys, baby boomers, the wealthiest and largest generation in America's history, are, spending their money. And where they spend their money, think about that, that's almost half of all the Airbnb bookings. So where they spend their money is where the demand is, and that's where you want to be investing. Myrtle Beach oceanfront condos. Myrtle Beach oceanfront condos are in a league of their own, guys. There are short-term rentals that can be a block off the beach, and they will not do nearly as well as an oceanfront condo will in our market. Trust me, you need to get in contact with me. I can give you the full scoop on it. Now, for those of you that don't follow the thought process that by eliminating taxes, federal taxes on these 3 sources of income, that it's going to lead to increased demand for vacation rentals, luxury properties, and senior assisted living facilities. Well, you might not be wrong. There are 2 sides to every story. Now, the policy doesn't directly benefit high net worth investors. It's important to recognize that. Obviously, they're not dependent on these 3 sources of income. Now, additionally, if consumer spending rises too fast, well, inflation can surge. And if inflation surges, real estate costs are going to increase, and ultimately interest rates are going to increase. Now, this is going to hurt leveraged investors. So over the course of the next 4 years, if we put all things into perspective, if you see interest rates start to rise, you need to be leery, especially if you're doing those commercial investments like senior assisted living facilities, because you're only going to get a 5-year loan term. Yes, it's going to be amortized over 25 years or 30 years or whatever, but your loan term is only going to be 5 years, which means which means that over the course of the next 4 to 5 years, if interest rates continue to rise, you bought it at, let's just say 7%, they rise to 9 or 10%. Whenever that loan term expires, you're going to have to find new financing for that property, sell the property, or you might not be able to afford the monthly payment. The interest rate at 5% on that loan versus the interest rate at 9% on that loan is going to be two completely different monthly payments. So you're going to have a much higher monthly payment, at the end of 5 years, and you might not be able to keep that property, which could obviously segue into a great investment for a lot of savvy investors that sat on the sideline waiting for those foreclosures. Just throwing that out there. Now, alternatively, you could shift your focus to recession-resistant real estate like apartment complexes, multifamily, in high-cost states, because basically rising inflation means that people are going to rent instead of buy, which we're already seeing now. And in these high-cost states, they're not going to be buying houses. They're going to be renting. So it's a really great way to kind of hedge if you're of the opposite mind, as opposed to, the whole vacation rental properties, luxury properties, and senior assisted living facilities. Now, increased spending led to as much as a 12% drop in home sales just in 2023. So there is a little credence or evidence to the fact that if you're of the mind that you need to go the recession-resistant route because you believe that interest rates are going to increase, then multifamily is going to be the best play for you based on President Trump eliminating taxes on tips, Social Security income, and overtime pay. Number 2 is that state and local tax, also known as the SALT deduction cap adjustment. Now, currently that SALT deduction is set at $10,000. That cap is $10,000. Now that means that investors in your high tax states like New York, Chicago, Illinois, basically they can't deduct the full amount of their state and local taxes from their federal taxes. Now let's kind of backtrack real quick and unpack what that means. Prior to 2018, if you had $100,000 worth of taxable income and you had $10,000 worth of state tax and $10,000 worth of property tax, which is $20,000, you could have deducted that $20,000 from your taxable income, giving you a new taxable income of only $80,000 for your federal taxes. Well, gone are those days. Now, by raising or eliminating the cap, high income investors in states like New York and California and New Jersey are going to ultimately save money. And when they save money, they're going to want to do something with that money. So it's going to increase their real estate purchasing power. Now, that's phenomenal news because they're going to be able to reinvest in those high tax states. So basically, if SALT deductions expand or are lifted, New York, California, and Illinois' luxury property markets will recover. Now, I already know what you're thinking. What do you mean by recover? So in order to understand why these markets need to recover, we're going to have to backtrack to 2017 and really explore how the SALT cap hurt these markets. As you know, in 2017, the Tax Cuts and Jobs Act was basically introduced the SALT deductions cap. And essentially, this made states with high income and property taxes like New York, California, Illinois, New Jersey, et cetera, more expensive for high income earners. Ultimately, as a result, many wealthy investors and even homeowners relocated out of these high tax states to low tax states. States like Florida, Texas, and Tennessee, reducing demand for high-end real estate in New York, Los Angeles, Chicago, again, those high tax states. Now, if Trump removes or increases the SALT cap, high-income earners in those states can deduct more of their state taxes again. This is going to reduce their effective tax burden, making buying or holding that high-end real estate in these areas more financially appealing. Now, this could also slow down the migration to low-tax states and even encourage some of the people that have already relocated to move back home. Now, that would obviously revive these luxury property markets in these cities. Now, luxury home sales in New York, Los Angeles, and Chicago could increase. again, reversing the recent slowdowns. And then also, high-end commercial properties may see higher occupancy rates, again, as those businesses that relocated to the low tax states move back to the high tax states. Now, another excellent thing is that developers might start luxury condo and mixed-use projects again, which had slowed due to the reduced demand from the high net worth investors that relocated out of the high tax states. Now, the SALT cap definitely had a negative impact on those high tax markets. Some evidence that we can clearly see is that New York City's luxury home sales dropped by 40% after the 2017 SALT cap was put through. And that's according to the Wall Street Journal. Further, California saw a net loss of $340 billion in taxable income between 2017 and 2022 due to wealthy residents leaving. Again, yes, they're leaving those high tax states and moving to those low tax states. So does this mean you need to run off to New York City, Illinois, California, and start investing in high-end properties? Yes, there is a timing component to it. If Trump repeals or raises that cap, those markets are going to rebound, which is going to make for an opportunistic investment in that high-end properties. Now, I'll tell you this, once a lot of investors catch on to this and they start moving into those markets, obviously those prices are going to rise. So there is a timing component. However, if taxes keep rising, especially in California and Illinois, well, it may not be enough to stop that out migration, which would make the low tax states a much safer bet for the long run. Now, back to what you need to know about how the SALT cap deduction is impacting you and where you can maximize your investment. In addition to investing in your high tax states, those markets with luxury properties in New York, California, Chicago, Illinois, et cetera, you might want to consider mixed use properties like in places like San Francisco or Manhattan. Those commercial properties could see some renewed demand because of that tax cut. Now, obviously, not all investors are going to benefit from the elimination of the SALT cap. Investors that live in those low tax states like Florida, Texas, Nevada aren't really going to benefit at all. On the other side of the argument, eliminating the cap could increase government deficits, which would lead to higher interest rates and ultimately negatively impact real estate borrowing. And I know that is a huge red flag for a lot of you because you use financing, especially on your commercial projects. And if you're thinking, hold on, how does government deficits negatively impact real estate borrowing? Well, I'm glad you asked because we're about to unpack that. So how does eliminating the SALT cap lead to government deficits and thereby raising the interest rates, which is negatively impacting your real estate borrowing? Very simply, guys, when that SALT cap deduction is lifted, eliminated, expanded, however you want to say it, that's going to reduce the federal tax revenue. Ultimately, when the federal tax revenue is reduced, that could lead to an increase in the federal deficit. If the federal deficit increases, well, very simply, the U.S. government might need to borrow more money. If they need to borrow more money, that's going to increase interest rates, which is going to negatively impact your commercial lending. Very simply put, less tax revenue equals higher budget deficits unless government spending is cut elsewhere. Now, before you think that the U.S. government might not have to borrow any money, let me give you this statistic. Over the next 10 years, if the SALT cap is eliminated, that's over $500 billion that the U.S. government wouldn't have. Now, higher deficits lead to more government borrowing. The federal government funds budget deficits by issuing treasury bonds, which is borrowing money from investors. Now, if tax revenue falls due to the SALT cap being repealed, well, the government's going to borrow more money to cover its spending. And more money, obviously, is going to increase the supply of treasury bonds in the market. Now, the U.S. national debt exceeded $34 trillion, making treasury yields highly sensitive to government borrowing. What that means is the federal government has borrowed an enormous amount of money. It's got a track record of borrowing money to cover spending. Now, because the U.S. government funds its debt with treasury bonds, investors demand higher yields, which are your interest rates when the government is borrowing more. Now, this makes borrowing more expensive for everyone, especially real estate investors. Now, Treasury bonds serve as a benchmark for other interest rates, including those mortgages and commercial real estate loans, making it more expensive to finance properties. When the U.S. deficit surged in 2023, the 30-year mortgage rate climbed to 8%. Now, guys, I want to walk you through 2021, our interest rate was 3%. 2022, our interest rate was 5 to 6.5%. Early 2023, it was at 6%. October 2023, it was at 8%. When the government borrows money, the interest rates increase. So how could this hurt your real estate investing in 2025? Well, three things are going to happen. One, higher mortgage rates are going to equal lower cash flow. If borrowing costs rise, those mortgage payments are going to eat into your profit margins, stealing your precious profit dollars, slowing your reinvestment rate down. I mean, it's going to hurt you. Less demand for expensive luxury properties. Again, if those mortgage rates rise, fewer people are going to qualify those loans. There's going to be less buyer demand, and that's going to bring you to the third thing, lower property values. As borrowing gets more expensive, investors may demand cheaper prices in order to compensate for the higher financing cost. Think through this with me, guys. If an investor gets a loan for $1 million at a 5% interest rate, the monthly payment is $5,368. If rates rise to 7% by 2 points, that same loan costs $6,653 per month. That's a 24% increase in borrowing cost. So, if eliminating that SALT cap raises government deficits, which then pushes interest rates higher, investors should lock in fixed rate mortgages now before rates increase even higher. Invest in cash flowing properties that generate income even if the interest rates or borrowing costs rise. And then you want to consider your seller financing deals, where you can negotiate those lower interest rates with property owners instead of banks. So the best markets for high interest rate environments are going to be cash flow heavy short-term rentals. We're talking Myrtle Beach, South Carolina, Smoky Mountains, Gulf Coast. Multifamily apartments with long-term demand, Florida, Texas, Arizona. Triple net commercial lease properties. If you need help with any of those three, pick up the phone and give me a call. I'm your broker to get it done. But what if the SALT cap doesn't lead to higher interest rates? Remember, there's always two sides to every story. So some economists argue that those wealthy taxpayers would reinvest their tax savings into real estate properties, businesses, or even stocks. That happening could stimulate economic growth, which would obviously offset deficit concerns. Now, let's get a little bit more granular. If the GDP grows faster than the debt, then the interest rates might not rise as much because tax revenues would increase from the economic expansion. Now, the Congressional Budget Office estimated that economic growth from the 2017 tax cuts helped offset as much as 20% of the revenue loss. Ultimately, if we all flourish and prosper, we will all do better. Now, if the deficit does not cause interest rates to rise, you want to leverage lower interest rates for aggressive real estate expansion. I mean, after the first year of seeing how this thing plays out, if those interest rates aren't rising, you need to start investing. You need to consider high-end real estate in those high-tax states. Again, where the SALT deduction makes investment way more attractive. Then you also want to consider investing in development projects that benefit from the increased real estate demand. We're talking short-term rental properties. We're talking senior assisted living properties, some of the stuff we've already covered. Now, the best markets, if rates stay low, are going to be luxury real estate in New York City, California, and Illinois. Ground-up developments in major urban centers. If you need help finding those, pick up the phone and call me, or short-term rental expansion in high-income areas. Guys, if rates stay low, New York City luxury real estate properties could see as much as a 25% rebound. Very simply put, if you believe interest rates will rise, you're going to focus on cash flow, fixed rate financing, and low tax states. If you believe that interest rates will stay low, then you're going to capitalize on that luxury real estate and leverage the long-term debt for growth. It's that simple and that easy, guys. Number 3 is the corporate tax rate reduction. Now, by reducing corporate taxes from 21% to 20%, and to 15% for manufacturers, we're effectively going to be seeing operating costs lowered for these businesses. Now, this is going to boost corporate profits, it's going to increase expansion, and it's going to create real estate demand for industrial properties like warehouses. So how do you maximize the benefits of the corporate tax rate reduction? Well, I'm glad you asked. First, you're going to invest in industrial properties like warehouses and production and distribution facilities because these corporations are going to continue expanding. Next, you're going to structure your real estate holdings as C corporations to take advantage of the lower tax rate. Now, talk to your CPA about that. Let's dive into, though, the industrial market just over the past few years since the Tax Cuts and Jobs Act was passed in 2017. Because industrial real estate vacancies dropped to 3.8% in 2023. And I'm going to show you how the Tax Cuts and Jobs Act since 2017 has been reducing that vacancy rate in the industrial space. Now, 2017, 5.3% vacancy rate. 2018-19, 4.8 to 5.0%. 2020 to 2021, again, that's the pandemic boom, 4 to 4.4%. You can see how it's dropping. 2022, 3.9%, and 2023, 3.8%. Guys, that is the lowest industrial vacancy rate in history. And again, that's driven by the Tax Cuts and Jobs Act incentives, reshoring of manufacturing, and continued e-commerce growth. Now, don't miss this. Over 70% of all new industrial space built in 2020 to 2023 was pre-leased before construction was completed. That is evidence of the demand in this sector of the commercial market. All right, now what I want you to see is just how much demand momentum is rolling and moving like a train on a track, rolling, all that momentum in the industrial real estate sector. So we're going to back up to 2017 and examine the Tax Cuts and Jobs Act and exactly what happened. Originally, it reduced the corporate tax rate from 35% to 21%, leaving businesses, of course, with more after-tax profits to reinvest in infrastructure, warehousing, and logistics. Now, many corporations reinvested those tax savings into their supply chain expansions, of course, increasing demand for industrial space. Now, after the Tax Cuts and Jobs Act, U.S. companies repatriated as much as $1 million in overseas profits. Correction, that is over $1 trillion in overseas profits. Back to the video. Much of which went right into business expansion and guess what? Real estate. Now, this gets even better when you start understanding that the bonus depreciation encouraged warehouse and factory investments. Ultimately, the Tax Cut and Jobs Act introduced 100% bonus depreciation. Now, this allowed companies to immediately deduct the full cost of new equipment and facility upgrades instead of having to depreciate them incrementally over time. Now, this made investing in industrial real estate way more attractive as businesses could upgrade or expand warehouses with major tax write-offs. An example would be a manufacturer that purchased a $10 million warehouse. Well, guess what? He could now deduct the entire amount up front, reducing his taxable income and freeing up capital for, guess what? Further expansion. Industrial property construction surged 37% from 2017 all the way to 2023. And it was fueled by none other than the Tax Cuts and Jobs Act. Now, let's say you're of the mind that with only a 1% decrease in that corporate tax rate reduction, that all that industrial momentum is going to begin to slow. And it's certainly plausible and definitely worth keeping your eye on the market. You want to have a sensitivity to the industrial sector in the commercial market, for sure. Additionally, I want to point out that not all industries actually benefit from the corporate tax rate reduction. Commercial office spaces have been lagging post-pandemic. I mean, with the new dynamic of remote work, there's been lots of people at home, and corporations have found a great place to cut operating costs by allowing workers to work from home. They don't need as much space. So it definitely doesn't impact everyone the same. Now, if businesses don't reinvest their tax savings, job growth and rental demand may not increase. So then if you're not going to invest in industrial, what should you do? I'm glad you asked. Let's consider diversifying beyond industrial. How about this? How about a bet that hedges you either way? If you invest in workforce housing near industrial hubs, this will ensure demand even if the corporate tax benefits don't stimulate expansion. I think it's a brilliant idea. And I will throw out that Amazon's warehouse boom did create over 250,000 jobs in 3 years, leading to rental price surges per Forbes. Now, I know you're thinking the same thing I was thinking. Hold on. If industrial demand slows down, well, that would mean that there wouldn't be demand for workforce housing. Let's examine that question deeper. Now, I'm going to give you 3 reasons why workforce housing near industrial hubs is still a smart move, even if industrial demand declines. Your first one is that jobs and workers still exist even if the warehouse demand slows. Industrial hubs already have large workforces. Even if companies stop expanding, the workers are still there and need housing. Now, companies may consolidate operations into fewer but larger facilities. That still keeps your jobs stable. And if the jobs are stable, guess what? The paycheck on your rental property is stable, which is something that you want. Now, 70%, and I'm excited to share this with you, 70% of warehouse jobs are held by workers earning between $40,000 and $60,000 annually. These workers cannot afford expensive properties, but they need affordable rentals. Now, renters in industrial zones are less impacted by market fluctuations. Warehouses and logistics workers are typically renters rather than home buyers, ensuring consistent rental demand. Unlike the high-end real estate market, workforce housing remains in demand because people always need a place to live, especially when it's located conveniently near their industrial hub, their work. Now, if you don't believe me, just pay attention to the history since 2020. From 2020 to 2023, multifamily rental occupancy rates stayed above 95% near these industrial hub zones. So we have a consistent track record that lets us know we're going to have strong rental demand in workforce housing. Now, if industrial construction slows, land prices and property costs may drop. Follow through with me on the logic here. Slower industrial demand could lead to less land competition, a reduction in land competition. There's less people putting their property on the market because there's not as much demand for industrial. So there's less competition, which means workforce housing developments would become cheaper to buy or build. Now, investors can acquire these properties at lower cost and then lock in that strong rental demand. Now, one quick caveat here is you always want to make sure that you perform what's called a gap analysis in the market. Now, when you perform a gap analysis, essentially you are looking for the number of properties in supply near that industrial hub and the number of potential buyers or the demand for those properties. You want to make sure that the demand exceeds the supply so that there is a significant gap that would justify your development. And if you don't believe there's demand already in and near these industrial hub sectors, well, multifamily rents in industrial hubs rose 8.2% year over year just in 2023. So there's already a history of demand. So if you are vibing with me on the corporate rate tax reduction done by President Trump, then Guys, you want to invest in secondary markets with logistics clusters. We're talking Columbus, Indianapolis, Phoenix. You also want to buy and or develop Class B or C multifamily units. Remember, they don't need the luxury end of the market. They can't afford the luxury end of the market. So you have to make sure that it's affordable housing that meets the workforce need. And then you want to use cost segregation studies to maximize those tax benefits. You want to accelerate depreciation to basically reduce your taxable income. And finally, you might even want to consider mixed-use developments like retail because wherever that workforce population is, they're going to need a local place to spend their money. As number 4 is going to be the elimination of the carried interest loophole. Now, the carried interest loophole is used by private equity firms, hedge fund managers, and real estate syndicates to pay lower capital gains tax rate of only 20% instead of the ordinary tax rate of 37% on their earnings. Now, I know you're probably thinking, what is carried interest? So carried interest is the share of profits, again, which is typically 20%, that fund managers receive from their investment management deals. Ultimately, let's just run through the math. A private equity fund that earns $100 million, the fund manager is going to get $20 million as carried interest. Now, under the current loophole, that $20 million is going to be taxed at 20% instead of 37%. That 20% tax is going to save him $3.4 million. Essentially, at the 37% tax, he would have a tax liability of $7.4 million. However, by getting the capital gains 20% tax rate, he only has a tax liability of $4 million. Again, saving him $3.4 million. So what happens when this loophole is eliminated? Well, I'm glad you asked. Fund managers and syndicators must now pay the higher 37% tax rate. Now, that's going to basically reduce their after-tax profits, making large real estate funds, hedge funds, and private equity firms less profitable. Fewer real estate syndications and large-scale property investments are likely to occur as a result of them being less profitable. Obviously, if they have less money, they're not going to be able to do as many projects. Now, private equity funds and hedge fund managers over the course of the last decade saved as much as $18 billion due to the carried interest loophole. And that's from the Congressional Budget Office. Now, how do I need to invest my money in real estate given the fact that the carried interest loophole is being eliminated? Well, I am glad that you asked, because basically there are 4 things that individual investors and small-scale real estate syndicators are going to need to do during this administration in order to maximize the benefits of the elimination of the carried interest loophole. Man, that was a mouthful. Number 1, syndicating smaller real estate deals. We're talking under $10 million to attract high net worth investors. Number 2, you're going to need to focus on direct real estate ownership. You need to stop relying on large private equity firms. Number 3, you're going to be investing in REITs that do not rely on the carried interest loophole and still provide you with some passive income. And then number 4, you're going to target niche assets like short-term rentals, small boutique hotels, or even smaller multifamily properties, which are easier for you to manage without having to have a massive fund structure. Now, the number of small private real estate deals under $5 million increased by as much as 30% in 2023, which tells me that basically individual investors were already seeking alternatives to these large institutional funds. That tells me that they anticipated the administration and they knew exactly what to do to position themselves to be that first mover, that fast mover, and invest. A 30% jump is a huge jump. So they were ready and they moved. And that's exactly what you've got to do now. Now, I know you're already thinking, okay, so won't large firms just find other ways to reduce their taxes? Yes, it's certainly plausible that some hedge funds and private equity firms are going to shift to different tax strategies like 1031, like-kind exchanges, opportunity zones, and then offshore structuring to offset the impact. And another big concern is, what if this discourages private equity firms from investing in real estate, reducing liquidity? Well, yes, this is a real risk. If large real estate funds slow their investment, well, guys, that's going to make financing availability for large-scale projects a lot harder. If they pull back, there's going to be fewer large-scale loans available, which is going to make it really hard for smaller investors to finance those large-scale properties. Institutional real estate investment dropped by 19% in 2023, and that was due to tax uncertainty and interest rates. Now, if you take into account that the number of small private real estate deals under $5 million increased by 30% in 2023, as individual investors sought alternatives to large institutional funds, per Forbes, guys, what's going on? What are the big boys doing? Well, 4 things are happening. Number 1, large firms are hoarding cash and waiting for market clarity. Number 2, big funds are moving away from large, high-risk assets. Number 3, large firms may be looking for distressed assets. And then number 4, large funds could be pivoting to debt instead of equity. Now, real quick, number 1, large firms are hoarding cash and waiting for market clarity. With a 19% drop in institutional investment, this suggests that acquisitions have paused due to economic uncertainty, tax policy changes, and interest rates. We've all seen this taking place in the market already. They're likely waiting on the rates to stabilize before they begin deploying capital aggressively. Now, number 2, big funds are moving away from large, high-risk assets. Institutional investors generally focus on the Class A multifamily, commercial assets, and luxury assets. Now, the pullback signals that they expect price corrections in the market due to financing challenges. Now, this is where it starts to get a little sticky. Number 3, large firms may be looking for distressed assets. Many private equity firms thrive on those downturns. By sitting on the cash, they can buy the distressed properties at lower prices. So essentially, they're waiting for things to correct so they can buy up properties, which is exactly what you should be doing. Now, number 4, large funds could be pivoting to debt instead of equity. Instead of buying properties, they may shift to private credit, distressed debt, or financing for smaller deals, offering loans to smaller investors at higher rates. Now, what does this mean for individual investors? Well, I'm glad that you asked. There is a temporary window to acquire the smaller deals before big money returns. Now, with institutional investors on the sidelines, individual investors can grab up these smaller properties, under $5 million properties at better prices before competition increases once they jump back into the market. Essentially, distressed opportunities are going to surge in 2025. If big funds are waiting for price drops, then distressed deals will rise. Now, I know you're thinking, what's the correlation there? How does that work? Kind of walk me through it. Well, as we've already said, big funds are sitting on the sidelines, they're sitting on their cash, and they're waiting. They're waiting until they can see a bottom to the market. Now, sellers who can't hold out must lower their prices. Many commercial property owners have to sell due to loan maturity dates, rising interest rates, or even just cash flow problems. Again, we've talked about if they bought at 5% interest and now the interest rate is at 9%, they've got a 5-year loan term, they've been holding this property, they can't refinance the property or find new lending because they can't afford it at the higher interest rate. What are they going to do? Well, they're going to it's going to become distressed and eventually get foreclosed if they can't get it sold. And without enough buyers at current prices, motivated sellers and banks are going to start selling those distressed properties at discounts to attract buyers. Institutional investors will basically re-enter the market now that they can see a clear bottom to it. But before that happens, and this is what's important for you, before that happens, small investors have a window of opportunity to buy distressed assets before competition heats up again. So investors have to be ready for those off-market deals, those seller financing deals, and the foreclosure deals. If you need to find any of those deals, give me a call. Now, you need to expect large firms to re-enter the market once interest rates drop. Once rates stabilize, institutional capital will begin to flood back in, driving those prices back up. they're essentially sitting on the sidelines, starving everybody out so that they can go in and make a profit. Simple and easy. Now, here's your series of moves that you need to do. There's three things. One, you need to buy at discounted prices before institutional investors re-enter the market. You need to target that workforce housing we talked about, short-term rentals we talked about, and small commercial deals, maybe like those smaller multifamily deals. You need to secure long-term fixed rate financing before interest rates drop and competition heats the market up. Those long-term fixed rates, guys, are where it's at for those vacation rental properties. Now, what should high net worth investors do? Well, ultimately, if large private equity funds reduce activity, then move toward direct ownership, small syndications, or REITs. That simple and that easy. REITs that are paying you passive income. If carried interest reform leads to institutional investment, then you're going to want to target distressed properties and alternative financing methods. Seller financing has never looked better. Number 5 on the list is incentives for U.S. manufacturing. So obviously, manufacturers get tax breaks for producing goods domestically. This increases demand for industrial space, for warehouses, for employee housing in those manufacturing states. Now, how can this benefit you? How can you use the current administration to your advantage when investing in real estate? I'm glad that you asked. So you're going to want to buy land near those manufacturing hubs. We're talking Ohio, North Carolina, Texas, before factories expand and drive up values. Before factories start expanding in those areas and driving those values up, you want to beat them to the punch. It's a timing game. It's that simple and that easy. U.S. factory construction spending rose 70% in 2023. It's already happening, guys. Now let's consider the other side of the story. There are always risks to every investment. What if manufacturing tax breaks don't lead to long-term job stability? I mean, you could be in this property, financed in this property for many, many years. Well, what if the market doesn't match your investment strategy? Well, if manufacturing doesn't grow as expected, warehouses could be overbuilt. Now, I always recommend a gap analysis to my commercial clients, especially looking in these areas. You just want to make sure that the supply does not exceed the demand in a given area. You don't want to build in a place where there's not enough demand to support your warehouse. Now, simultaneously, I understand you are beating these places to the punch, so there's more inherent risk. In order to kind of subvert some of that risk, you can do short-term leasing for flexibility. So you can do lease-to-own industrial spaces to avoid long-term risk. Guys, this right here is so good, I can't wait to share it with you. So the investor acquires an industrial property or land near that manufacturing hub. Now walk through this with me because I have 4 points that are going to carry you from here to wow. Now, instead of selling the property outright, the investor is going to lease the property to the manufacturer with an option to buy, let's say in 3 to 5 years. Now, this allows the manufacturer to test the location before committing to full ownership. So for the tenant, it's a smart move. It gives him a little bit of flexibility. Now, on the flip side, let me show you what this does for you as the investor. The manufacturer is going to pay a higher lease rate for the purchase option. So because the lease includes a future purchase option, the tenant or the manufacturer pays a premium compared to a standard lease. So the investor is going to earn a stable cash flow up front for that first 3 to 5 years, while still benefiting from the potential appreciation on the back end before the sale. It's a double win for you. Now, if demand remains strong, the manufacturer exercises the purchase option. If the manufacturer incentives succeed, then the tenant is going to buy the property at the pre-agreed price, ensuring the investor locks in a profit. Yay, 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 everybody's happy. Now here's where you win again. If property values rise faster than expected, well, the investor can renegotiate or sell at the new market value. Now, if manufacturing slows down, the investor still is going to keep the property. If the tenant doesn't buy, the investor still owns the property and can lease it to another industrial tenant or sell it in a rising market. This mitigates the risk of overbuilding since the investor isn't locked into ownership without rental demand. Essentially, you're hedged against the overbuilding that could take place in the market because you have a tenant in your property. You're safe either way. Now, U.S. factory construction spending rose by as much as 70% in 2023. Lease-to-own strategies, guys, allow investors to benefit from this surge while managing all of the downside risk. So what's the best move for a high net worth investor? Well, essentially, you've got three moves. One, you're going to use the lease-to-own strategy for those properties in high-demand manufacturing areas. Number two, if uncertainty about long-term demand is still in play, then you can resort to short-term leases on these properties. And then finally, you're going to monitor industrial vacancy rates and tax policy changes to adjust your strategy. It's that simple and that easy. Thank you so much for watching the video with me. Guys, if you want the most up-to-date information on how the tax cuts are going to impact real estate investing in 2025 and the forthcoming years, then please subscribe to the channel and hit that like button. Now, for all of you guys out there that are looking for the right investor broker to help run your numbers on your deal, to do analysis, to do strategic analysis on your commercial deals, or maybe short-term vacation rental properties, or perhaps you're looking at buying those boutique hotels or maybe multifamily properties, get in contact with me. I have lots of investors that reach out to me every day with text messages and emails all the time. I get it constantly. And you don't want to end up like those investors that tell me, I thought about this for 4 years. I talked to a guy today who said, I thought about this for 4 years. And I mean, most investors, in my opinion, wait at least 2 years. They procrastinate. They go at it alone. Save yourself time, energy, and effort by picking up the phone and calling me or shooting me an email so we can just talk through the variables of your deal, where you are currently, and what you want to accomplish, even in the next 6 months to a year. I had a gentleman just today he contacted me about a few months ago, wasn't ready, was getting some things in order, got things in order, got his pre-approval 7 days ago, and he's under contract right now. It's that simple and that easy. You don't want to end up like the guys who wait 4 years, they're doing it alone, they're getting bits and pieces of information from here and there. They don't have a full story. You need the right person. The right person can help you go from not having a solid investment to building generational wealth really quick and really fast and in a hurry. So don't be a stranger. It's 843-360-1737. Get a hold of me.